Hello everyone, this week we are going to learn the costs of production. Let's start with a couple of definitions before we dive into the costs of business. First, we have an assumption. The goal of a firm is to maximize profit. Total revenue, which is represented by TR, is equal to P times Q. P is the price and Q is the amount. So it is the amount a firm receives for the sale of its input. Total cost, TC, is the market value of the inputs a firm uses in production. So the profit is the difference between total revenue and total cost. Let's see this example. Jelani owns a small gelato shop on campus. She can make 15,000 pints of gelato a year and sell them at $5 each. If Jelani's total costs are $65,000 a year, how much profit the job brings in 1 year? So in order to calculate this, first we need to find the total revenue. Remember, total revenue is the price times the quantity, which is $75,000. And we know the total cost, which is $65,000. So the profit is the difference between total revenue minus total cost, which in this case 10K. We have two types of costs in economics, explicit and implicit costs. But before we understand what are these costs, remember that the cost of something is what you give up to get it is called opportunity cost. Explicit costs are the input costs that require an outlay of money by the firm. For instance, paying wages to workers is a type of explicit cost. Implicit costs, on the other hand, these are also costs, input costs, that do not require an outlay of money by the firm. For instance, opportunity cost of the owner's time. So total costs, when we say in economics total costs, we refer to sum of explicit and implicit costs. So what are these owner-supplied resources? Owner-supplied resources might be the money provided to the business by its owners, because that money could be used to earn some return if it's not used in the business. Second, time and labor services provided by the firm's owners. That means if the owner doesn't provide the time and labor services, owners could earn somewhere else a wage. And third, any land, buildings or capital equipment owned and used by the firm. Instead, if there is no business over there, the owner could rent this building or land or capital equipment and earn some income. Therefore, these are all foregone opportunities with the resources that are used in the business. So let's see this example to understand explicit and implicit costs. Jelani owns a small gelato shop on campus. Jelani pays $20,000 a year for raw materials and $12,000 in rent. Jelani can work at the local coffee shop for $25,000 a year. Identify and calculate the explicit and implicit costs. Remember, explicit costs are the ones that require cash outlay. Here, in this case, Jelani needs to pay $20K a year for raw materials. It's a cash outlay plus $12K for the rent. Therefore, $32K is the explicit cost. Implicit cost does not require cash outlay, but they are still costs because the owner uses his or her time for business. Therefore, the foregone wage, $25K, that could have earned in a year if Jelani doesn't have the gelato shop, is the implicit cost. So the total cost is the sum of these two, 32K plus 25K, which in this case 57K. Let's see another example of an implicit cost. Jelani invested $80,000 in the factory and equipment to start the business last year. $30,000 come from savings and borrowed $50,000. Interest rate is 10% for saving and borrowing. Identify and calculate the explicit and implicit costs. So if you have a bookkeeper, an accountant, probably the accountant is going to calculate the amount of costs that you pay because of borrowing 50K. So which is the interest, right? Because you have to pay interest of 10% every year, which in this case, it's going to be $5,000. So $5,000 is an explicit cost because you have to pay from the business, is a cash outlay from the business. But what happened to 30K? 30K you use from your savings, so you might think that there is no cost to it. Unfortunately, there is, because if there is no business, then you can use this 30K to earn a 10% interest rate from a saving account from an asset and anywhere else. Therefore, you are giving up of an interest income of 3K. So here the explicit cost, that means this is the cost, that's a cash outlay, money outlay from the business, is the 5K, and there is an implicit cost, which in this case 3K, that you give up return on your saving in order to have the business. Total cost in this case is 8K. Now let's talk about two types of profits, economic profit and accounting profit. Accounting profit is total revenue minus total explicit costs. So accountants do not count implicit costs when they calculate the profit. The reason I think it's clear, because implicit costs are too much subjective and it's hard to include in the bookkeeping. Therefore, accounting profit does not include the implicit costs. Economic profit is usually helps us to make the right decision. Therefore, it includes all types of costs, and economic profit is equal to total revenue minus total cost, which includes explicit and implicit costs. Accounting profit ignores implicit costs, so it is usually higher than economic profit. Let's see this question. Raj opens up a lemonade stand for 2 hours. He spends $10 for ingredients, this is an explicit cost, and sells $60 worth of lemonade, this is the total revenue. In the same 2 hours, he could have mowed his neighbor's lawn for $40. Raj has an accounting profit of $60 revenue minus the explicit cost, $50. But for the economic profit, total revenue minus explicit cost minus $40 implicit cost, therefore economic profit is 10. As you see, accounting profit in this case is higher than economic profit. Another example, your aunt is thinking about opening a hardware store. She estimates that it would cost $500,000 per year to rent the location and buy the stock. In addition, she would have quit her $50,000 per year job as an accountant. What is your aunt's opportunity cost of running a hardware store for a year? If your aunt thinks she can sell $510,000 worth of merchandise in a year, should she open the store? So the first, we need to find the opportunity cost of running hardware store. Opportunity cost is the sum of both explicit and implicit costs. In this case, 500K is the explicit cost because it's cost of opening the hardware store. Plus 50K is the implicit cost because it's the foregone wages. Therefore, the opportunity cost is 550K. And if your aunt thinks that she can sell $510,000 worth of merchandise, which is revenue minus the total cost, we have a negative economic profit. Negative economic profit means that you shouldn't do this business because there is a better alternative. If you work for somewhere else, you could make more instead of doing the business. This is the economic profit, as I said. Let's calculate accounting profit. Accounting profit is the revenue minus the explicit costs. So as you see, you have an accounting profit of 10K. So if you do this business, you are making 10K a year, but economic profit is telling you, okay, if you do this business, you are giving up 40K of income. Therefore, don't do this business. Work as an accountant and earn 50K instead of earning a 10K. Let's see this example. Jelani owns a small gelato shop on campus. She can make 15,000 pints of gelato a year and sell them at $5 each. Jelani pays $20,000 a year for raw materials and $12,000 in rent. Jelani can work at the local coffee shop for $25,000 a year. Jelani invested $80,000 in the factory and equipment to start the business last year, $30,000 from savings and borrowed $50,000, and interest rate is 10% for both saving and borrowing. Calculate accounting and economic profit. Let's start with first revenue. Revenue is $5 times 15,000 pint of gelato, which is 75,000. Explicit costs are raw materials, rent, and interest paid. In that case, raw materials are 20,000, 12,000 is the rent, and then 5,000 comes from 50,000 borrowed times 10% interest rate. Therefore, total explicit cost is 37. Implicit cost is the alternative job plus foregone interest. In that case, alternative job pays you 25,000 and 3,000 is the interest on the saving account, remember, and that's 28,000. So we can see accounting profit, remember, total revenue minus explicit cost. Total revenue 75K minus explicit cost 37K, $38,000 you are making from this business. When you look at the economic profit, is total revenue minus total cost, which includes explicit and implicit cost. So you're subtracting 37K plus 28K from 75,000, which brings us to 10K. So let's see this example. The equilibrium rent on office space has just increased by $500 per month. Determine the effects on accounting profit and economic profit if you rent your office space. If you rent your office space, that is going to be an explicit cost. Therefore, your accounting profit is going to calculate this $500 as a cost. Your accounting profit is going to be lower. If you own your space, accounting profit is not going to count this as an explicit cost. Therefore, accounting profit in this case is going to be higher. For economic profit, it's the same in both cases because economic profit is going to count 500 whether it's an explicit or an implicit cost. Now, the next topic that we are going to talk about today is production and costs. Let's make some assumptions first. We are talking about production in the short run, and at least one input is fixed. In this case, factory size is fixed. It's hard to expand the factory in the short run. The only way to increase the production is to hire more workers. And production function shows the relationship between quantity of inputs used to make a good and the quantity of output of that good. And production function gets flatter as production rises. Let's see this example. Xavier has a popcorn truck, which is a fixed resource that he takes to fairs and supporting events. He can hire as many workers as he wants. The quantity of output produced varies with the number of workers. If Xavier hires only one worker, his truck will produce 30 buckets of popcorn per day. If Xavier hires 5 workers, his truck will produce 100 buckets of popcorn per day. So let's see Xavier's popcorn production function. As I said, we cannot change the truck. Truck is fixed. And what Xavier can change? Hiring more or less workers. And if it's 0 workers, 0 buckets. And when you increase the workers, the amount of popcorns produced are increasing. Therefore, the production function shows the relation between number of workers and the quantity of output is produced. Here, in this case, production function is shown on the screen. The next important terminology that you need to know is marginal product. Marginal product is the increase in output that arises from an additional unit of input. And when we think about marginal product of one input, other inputs should be constant. So if you have marginal product of capital, marginal product of labor, so when we talk about marginal product of labor, we assume that capital is fixed. Marginal product of labor is equal to MPL, change in the total product when you change the labor by 1 unit. If Xavier hires 1 more worker, his output rises by the marginal product of labor. Let's see this example. 0 workers, 0 buckets. When Xavier hires 1 worker, he produces additionally 30 units of bucket of popcorn. 2 workers together produces 55, but I want to know what is the marginal product of the second worker, which is the change in the output. So the output increases by 25. Therefore, the second worker's marginal product is 25 buckets. The all 3 together here produces 75, and I know that 2 together produces 55. What is the marginal product of the third labor? It is the increase in total output, in this case 20. And here the fourth labor's marginal product is the increase in output, which is 15. The fifth labor's marginal product is 10. This is how we calculate marginal product. Xavier must pay $200 per day for the truck regardless of how much popcorn he produces. The market wage for popcorn makers is $50 per day. So Xavier's costs are related to how much popcorn the truck produces. So here we see that the number of workers and the number of popcorns are produced. Cost of truck is always $200 per day, but we need to find out cost of labor, right? Cost of labor is going to change depending on how many workers you are going to hire. If you have only 1 worker, then the cost of labor is 50. If you have 2 workers, then 50 times 2 is 100, 3 workers 150, 4 workers 200, and 5 workers 250. So the total cost is going to change. Why? Because there is a fixed cost of truck, but there is a variable changing cost of wage. So total cost is the sum of these two. Now let's see the total cost function. Total cost function shows the relation between total cost and quantity of output. So when you have 0 popcorn, you pay 200. When you produce 30 popcorn, total cost is 250. 55 popcorn, it's 300, and so on. So let's now talk about diminishing marginal product. Before that, let's find the marginal product of workers on the table. So the marginal product of first labor is 45. Why? Because change in output is 45. Marginal product of the second labor is the change in output, which is 40. And the third labor is the change in again output, which in this case 30. And here change in output, which in this case 20, and change in output, which is 10. So as you see, marginal product of labor is going down. The first labor adds 45 units, second 40, third one 30, fourth one 20 additionally, and fifth one adds 10. Let's answer the questions. What is the marginal product of the second worker? 40. What is the marginal product of the fourth worker? 20. Does this production function exhibits diminishing marginal returns? Yes, it exhibits diminishing marginal returns. Let's see this example. Workers and the number of pizzas. Let's calculate the marginal product. The first worker's marginal product is 5. Second worker is 10. Third worker is 5. Fourth one is 2, 0, and -4. So as you see again, marginal product first increases and then decreases. That's exactly what happens in real life. So why we see this relation? Why we see that first labor is more productive compared to the fifth and sixth one? Why we see an increasing marginal product at the first time and then decreasing marginal product? So in the first stages of production, when you have a fixed resource like a company, truck, you have only fixed space. When you add more workers, they become more specialized, right? They become specialized so they can just do one task at a time and you become more productive. But as you add more and more worker, if you have only fixed resource, that means a fixed space, fixed restaurant space, fixed truck space, then the workers make the space crowded. So they get in the way of the other workers, so the productivity goes down. Therefore, in the short run, we see that diminishing marginal product because of fixed resources we have. So why MPL diminishes? Pizza store's output rises by a smaller and smaller amount for each additional worker. Why? As store adds workers, the average worker has less space to work with and will be less productive. In general, MPL diminishes as L rises, whether the fixed input is store space or capital, equipment, machines, and etc. So diminishing marginal product, the marginal product of an input declines as the quantity of the input increases. Now let's look at different types of measures of costs. As you remember, we talk about total cost, and total cost is sum of fixed costs and variable costs. Now we are going to learn what is a fixed cost, what is a variable cost. And fixed costs do not vary with the quantity of output produced. Remember, the truck, renting the truck costs $200 for Xavier, and that's a fixed cost because whether he produces or not, he has to pay that. So Xavier incurs this cost even if the production is 0. Variable costs, on the other hand, vary with the quantity of output produced. Remember, Xavier, if he wants to produce more, he hires more labor, but then labor cost was increasing as he adds more labor into business. Therefore, it varies with the quantity of output produced. Here you can see one example. Angel's knitted scarves business. Angel lost to knit scarves. Angel paid $18 for 2 pairs of knitting needles. So that means the fixed cost is $18. Remember, you can't change one of the resources in the short run. That's why it's called short run. To produce more scarves, Angel needs more yarn and more workers. Therefore, more yarn and more workers means the cost is varying with the amount of scarves that Angel wants to produce. So fixed cost, variable cost, and the total cost is the sum of these two. Remember, fixed cost is a positive number even if you produce 0, but variable cost is 0. When you don't produce anything, you don't have to pay. Therefore, the total cost is the sum of these two. Let's see the curves here. Fixed cost doesn't change, so it's a horizontal line at $18. Variable cost is actually first increasing at a decreasing rate and then increasing at an increasing rate. Total cost is higher than variable cost because you have to add fixed cost on top of that. And we have several different types of costs too. Average fixed cost is fixed cost divided by quantity. Average variable cost divided by quantity. average total cost, either total cost divided by quantity or average fixed cost plus average variable cost. Average total cost is the cost of typical unit produced, total cost divided by the quantity of output. There is one important term that you need to be aware of is the marginal cost. Marginal cost is the change in total cost when you change the quantity by 1 unit. The increase in total cost that arises from an extra unit of production. So let's see how we calculate average fixed cost. Remember, average fixed cost is fixed cost divided by quantity. Here the quantity is 1, 18 divided by 1, 18. Quantity is 2, therefore 18 divided by 2, 9. Quantity is 3, 18 divided by 3, 6, and so on. As you see, average fixed cost goes down when you produce more and more output. Therefore, average fixed cost curve is downward sloping. It starts with the highest level here because with the first unit you pay 18, and then it goes down because the cost is spread over the quantities you produce. Now let's see average variable cost and average total cost. The same idea, average variable cost is variable cost divided by quantity, average total cost divided by quantity. Here 15 divided by 1, 15, 25 divided by 2, 12.5. Let's look at ATC, 33 divided by 1, 33, 43 divided by 2, 21.5. And these are the ATC curve and AVC curve. And here, when ATC and AVC minimizes, it's called efficient scale. This is the quantity that minimizes average total cost. Now let's calculate the marginal cost. Remember, marginal cost is the change in total cost when you change the quantity by 1 unit. Here, when you have 1 more unit, your total cost increases by $15. 33 minus 18. You add 1 more unit here, total cost increases by 10, therefore marginal cost of producing the second unit is 10. The third unit, increasing the production by 1 more unit, your total cost increases by 5. And then the fourth unit is $2. As you see, when you add more and more units, you're adding some cost to your total cost, and that's called marginal cost. And when you look at the shape of marginal cost, it's first decreasing, and then it reaches a minimum point and it increasing back when you increase the number of output. So here are the cost curves all together. ATC is higher than AVC, and AFC is a decreasing curve, and marginal cost curve is decreasing first and then increasing afterwards. Angel's ATC and MC curves. When marginal cost curve is below the ATC curve, ATC is falling. When marginal cost curve is above the ATC curve, ATC is rising. So the MC curve always crosses the ATC curve at the minimum of ATC curve. So this is the efficient scale. So MC always crosses ATC at the efficient scale. So does this make sense? Yes, this makes sense. Let's think about one real life example. GPA, your GPA is an average grade. Right? If your GPA is 3.0, that means you have average B, letter grade B. So if you get from this class an A, this is your marginal grade, which your marginal grade is higher than your average grade. Marginal grade is higher than your average grade. Then this is going to pull up the average grade, right? Your average grade is going to increase, your GPA is going to increase. But if you add instead a grade lower than your average, then your marginal grade is going to pull down your average grade, GPA. That's what happens, okay? Your marginal is less than your average grade, it pulls down your average. Your marginal grade is higher than your average and it pulls up the average. So let's fill in the blank spaces of this table, starting with the first one. What is the variable cost of producing 0 units? As you know, it's 0, right? There is no variable cost when you produce nothing. And let's look at here, what is the total cost of producing 1 unit? Variable cost is 10. And we know that here it's not written, but there is a fixed cost because total cost is 50, but total cost is the sum of VC plus FC, and VC is 0, so therefore 50 is fixed cost for every level of output. And here 10 plus 50 should be 60. AFC should be 50 because 50 divided by 1 is 50. Here this blank is asking AFC of producing 2 units. 25, right? 50 divided by 2, 25. AVC is this one divided by 2, 15. So what is ATC is the sum of these two, which is 40. And let's find the marginal cost of producing the second unit. It's the increase in total cost, increase in the total cost when you produce the second unit. Increase in total cost is from 60 to 80, 20. Here is asking about VC. And we know that AVC is 20. So if you multiply 20 by 3, you will find the variable, total variable cost. Each unit you pay $20 in terms of variable cost. For 3 units is 60. Total cost is 60 plus 50, which is 110. And here is asking average variable cost. Total variable cost is 100 divided by 4, it's 25. And now this is asking marginal cost of producing the fourth unit. It's asking what is the increase in total cost if I produce the fourth unit, which is 40. Here it's asking total cost 150 plus 50, 200. AFC is fixed cost divided by 5, which is 10. And ATC is the sum of these two, which is 40. And it's asking here what is the marginal cost of producing the fifth unit, which is the increase in total cost when you produce the fifth unit. In this case, it's 50. So let's talk about the difference between short run and long run. In the short run, some inputs are fixed. Factories, land, that's why it's called short run. You can't change the factory size, you can't change the land size. And the cost of these inputs are called fixed resources or fixed costs. Long run, on the other hand, all inputs are variable. Long run is a period of time that you can change the size of the factory, you can change the size of land and so on. So that means firms can build more factories or sell existing ones. In the long run, average total cost at any quantity is the cost per unit using the most efficient mix of inputs for that quantity, which represents the factory size with the lowest ATC in the short run. So let me explain what I mean. Let's say long run average total cost with 3 factory sizes. Firms can choose from 3 factory sizes. For a small size, this is the best ATC. For medium size, this is the average total cost. And for large factory, this is the average total cost. So the firm can change to a different factory size in the long run, but not in the short run. Therefore, there are some quantities, right? To produce less than quantity A, the firm is going to choose size S in the long run because that gives the lowest average total cost. And if the firm wants to choose between QA and QB, then the firm is going to choose size M in the long run because size M is going to give you the total lowest cost, you see here. And then if the company produces more than QB, the firm will choose size L in the long run because that is giving you the lowest possible cost. Therefore, the long run average total cost is the combination of all these red lines that we draw on the screen. That is the long run average total cost. So in the real world, factories come in many sizes, each with its own short run average total cost curve. Therefore, a typical long run average total cost curve looks like this. You don't have only 3 sizes, but very different sizes, and you need to choose the best size to minimize the cost given the quantities you want to produce. And therefore, long run average total cost intersects with the lowest level of all short run average total cost curves. We have economies of scale in the long run. So what is economies of scale? Long run average total cost falls as the quantity of output increases. So why do we see economies of scale? Because in the long run, there is an increasing specialization among workers, more common when quantity is low. In constant returns to scale, long run average total cost stays the same as the quantity of output changes. And finally, we have diseconomies of scale. Long run average total cost rises as the quantity of output increases. Why do we have this problem? We have this problem because there is increasing coordination problems in large organizations. Management becomes stretched and can't control costs, and that's common when quantity is high. So as you see in the first section of the long run average total cost curve, we see economies of scale. Cost is decreasing when you increase output. And then we have constant returns to scale. ATC stays the same as quantity increases. And finally, we have the diseconomies of scale. ATC rises as quantity increases. So this is the end of this chapter. Thank you.